So Dan, we found out in our last video that all of Canadian bank results were pretty solid, but you were especially happy with CIBC.
Yeah, I mean, they showed good results compared to the other banks in terms of the Canadian banking segment was particularly strong. But I think the thing that drove that wasn't necessarily growth, which has been pretty stagnant lately. It's been primarily through lower provisions for credit losses, which has been a direct result of their lower gross impaired loans, which have declined by about 17% over the last year. Compared to most of the other banks, they've been stable to slightly increasing, so they've shown some good good progress in that front. Another thing that they're doing is that they're bringing in all their mortgage originations in-house, which is giving them better margin, and that continues to help solidify their revenue flows.
Okay, and I know in the past you've been concerned with CIBC's risk. Mm-hmm. So is that still a concern?
Not as much a concern in terms of the overall company. This is a company that's been trying to de-risk for some time. They had problems back in the mid-2000s with some of their capital markets structured notes that they had. They're still winding those down, but it's not nearly as big impact as it happened back then. In terms of risk at CIBC, I think the biggest risk, since it is, most of their income is from the Canadian banking segment, and a large portion of that is related to residential home lending. So that is always a concern, but up to this point, they seem to be managing it very well. Again, they're originating the mortgages in-house. The gross impaired loans seem to be coming down. So, if there's a concern that I'm looking for, it would be, in terms of growth, maybe hopefully see that a little bit better, but more specifically in the non-performing, the gross impaired loans and what they do going forward.
Okay, so as we move forward to Q4, what about CIBC's biggest three segments? What are you going to be looking for in those in Q4?
Well, again, with the Canadian banking segment, I'm looking at the gross impaired loans. I'm look for more growth. Compared to their other Canadian brethren. The wealth management segment has done very well for them with the acquisition of American Century a couple of years ago. They've seen better assets under management and fee income as a result of that. The wholesale segment had good trading revenues this quarter. So all in all, those two segments kind of go as the market goes. If the market does very well and the assets under management increases, you're going to get better fee income. If market retreats and assets under management comes down, obviously they're going to see lower fee income. So, there's some external factors at play there, but, those are the kinds of things that we'll look at going forward for CIBC.
Okay, and lastly, the question on everyone's mind, dividends. How was the CIBC?
CIBC didn't raise dividends this quarter, but given the history and as well as the steady revenue streams and income that they've shown, they will probably raise dividends this quarter, even with the loss of the Aero Gold credit cards, which was about $6 billion and almost 10% of their income. So they reached agreement with AMIA as well as TD Bank. They will only transfer about $3 billion of that, which is kind of a positive for them. They could have lost almost 10% of their income. So, given that has been preserved, I would look for CIBC to raise dividends with their fourth quarter announcement.
Great. Thanks so much, Dan.
Thanks.
To get more information on CIBC and all the big banks, go to the stock section of Morningstar.ca.